Hi, Tim. We've just finished a podcast on the virtues of a discretionary fund management offering for our clients. Now, I'd like to take a dive into the world we are currently in and explore your role as investment director, looking at how Rowan Dartington sees the investment markets. As we are, it's the 15th of June, 2022, and it's fair to say that we have had some major topics come to the fore over the last few months. With the advent of higher inflation, followed by war in the Ukraine, potentially throwing fuel on that fire, as well as COVID restrictions coming and going and coming back in China. What are you and Rowan Dartington seeing as the major challenges aside from those things, or what are those things causing as the major challenges at the moment?
I think you have hit on the major challenges.
Yeah.
Yes, which is the biggest one? I think probably inflation is. I mean, it has shot up, as we know, very quickly, and it's worldwide. You know, there's maybe a few exceptions where it's not as great, but it is going to have a significant impact on consumers. And a lot of it, as we know, is driven by energy prices, and we know that that is linked very much, obviously, to the Ukraine-Russia situation. And I don't think that is going to alter anytime soon, whilst the world is obviously looking for alternative ways to route fuel, different types of fuel, rerouting supply chains, etc. It will take time. So I think the inflation problem that we have is going to be here for a while. I suspect it will peak in the next few months, but it's going to stay, in my view, at an elevated level. What that elevated level looks like, I'm not sure at this point, but a lot's going to hinge on the fuel price, and the direction of travel, doesn't indicate any pressure is yet being taken off of that.
Yes, exactly, and obviously with fuel being the biggest input cost into inflation, I suppose, or production of anything that's going to be inflationary. How much do you think the central banks can and will try and affect a reduction in the inflation figures through interest rate hikes? How much of that is going to happen that's not necessarily going to actually be the reason that inflation comes down?
Yeah, I kind of feel they're in between a bit of a rock and a hard place, because it's not demand really which is the main driver of the rise in energy prices, as we know. It's on the supply side. So putting up your base rate isn't going to make a whole lot of difference. So having said that, they are clearly putting interest rates up. I think, and I think what's happened is they wanted to put rates up a long time ago, and they, frankly, I think, easy with hindsight, but they should have done. I mean, if you look back to the financial crisis, when they dropped interest rates down to something like 0.5%, 0.25%, they were saying at the time, this is an emergency rate, with the indication that it was not going to be staying there for very long, but it had stayed there for more than a decade. And of course, that then gets baked into everyone's thinking. It gets baked into economic models. It gets baked into business plans. It gets, it's in everything. And now, obviously, they're pushing it up, and that's going to have quite an impact. And I suspect it's partly they want to get it back up so they can bring it back down again. So there's an element, I sense, of psychology in this, the whole idea of forward guidance, which they've, particularly the Fed, has used effectively. Yeah, it will be interesting to see, but I think the other problem is wage inflation. Obviously, within inflation where it is, real wages are falling quite sharply, and there will be a lot of demand for increased wages, which is what they want to kind of stop in a way. I mean, it's tough. It's a tough one.
Yeah, I think it is, and obviously there's several forces that have come together to create this perfect storm. Really, with all the quantitative easing, but also coming out of COVID in most countries in the West. and also China still remaining within sort of these restrictions, and then having supply issues, and we've got supply chain bottlenecks and problems, and the rising fuel prices causing delays with shipping and all kinds of commodities for food and produce, etc. It sort of all come together at the same time. And yeah, I think we could be in for a period, like you say, of sustained inflation. Maybe not sustained at these levels. Hopefully, these are the higher levels. Might be the transitory bit that they were talking about a long time ago, that very quickly no longer mentioning. But it might feel high to a lot of people because we haven't seen inflation for so long. But yeah, much higher than we've been for a while. In looking back over history and maybe looking forward to now, and further on, what's been the best way to protect or indeed make money or profit from an inflationary and rate rising environment?
Sometimes commodities have been quite a good place to be. Equities again pick your equity, but it can be equities, but it also depends on the level of inflation. I think if inflation is too high, it's very difficult to find anything that is going to protect against that. But yeah, commodities, equities broadly, we would say are a place to be. You have obviously got index-linked, inflation-linked bonds that work. Again, you have to be a little bit careful because if you look at something like US tips, then depending on the currency you're working in, it can make quite a big difference. So again, the currency markets, play a big part in this as well. I mean, for our part, we had a discussion last week at the Asset Allocation Forum about inflation and about our current positioning, and we are overweight equities. So we're overweight to the tune of 6% against a neutral position of 65. So we're at 71. This is for a medium risk portfolio. Yeah. And we decided we didn't want to change that because partly this argument around where you best able to protect against inflation. But looking at what markets are doing at the minute, it doesn't give you any sense that protection is there, but then you've got a different driver here. You've got an overvaluation coming off from the equity market. So again, nothing is ever black and white. It's all very, very complex.
Yes, I think it's almost a case of the two sides of looking at it. A lot of fixed income, has enjoyed interest rates coming down and down and down and down and down, and for such a long period of time. And the risk, I think, there is that we don't always quite understand how, when you've got zero or close to zero yield or interest rates, when things move up, if it goes up by half a basis point, that's a significant change to the yield or the basis point. So in percentage value terms, that can create a lot more volatility than maybe people traditionally look at fixed income at.
Yes, I was looking at some of the 10-year gilts, so UK market, and how far they've come off from their peak, and they're off over 20-odd%. Now that's a conventional gilt, and that's a very big move. Again, if you look back at history and what you would expect a gilt to do, you don't expect that type of size of move. But it is part and parcel of, as you're saying, very, very low interest rates. And yeah, any move in those rates is going to have a magnified effect. And that obviously is going to play through into the economy. So yeah, and the other factor is, you mentioned interest rates long term having come down, and if you look at QE as well, and you look at the correlation between the S&P 500 and QE, there's a very tight correlation, which has driven asset classes, equity and fixed interest, up, and now you've got the reverse of that happening. You've got QT instead of QE. You've got inflation, and there is looking like a lot of strong correlation on the way down at the minute.
Yes, yeah, absolutely. And also, I suppose there's an element of, with quantitative easing, you know, the balance sheets have been increased hugely, on the governments, that a bit of inflation can really, help reduce that in real terms, and indeed, maybe have a period of time that's more like a financial repression, that they maybe need to get a grip on it.
Yes, I mean the inflation from that point of view helps the government. The government, I think, secretly might be quite happy to see a bit of inflation. But then as interest rates go up, and obviously that's going to increase the cost of further borrowing for them. So again, not straightforward, a bit of a double-edged sword. So yes, technically inflating some of the debt away, but the new debt that's coming along is going to cost you more.
Yeah, as long as
Yeah,
as long as they can push the refinancing down the line, then it might be okay.
yeah,
So we've previously talked about ESG investing, and how, in fact, in the last few years, it's um, probably overall been a outperformer versus non, traditional, equity investing. I suppose that's not got that focus. How have the events of the last few months changed that view, or haven't they?
I don't think they have changed anything really. I think if a lot of the ESG is focused on the environmental piece, and the state of the planet. In fact, the climate crisis is still here. It's just getting worse, frankly, by the day. We had a drop in carbon emissions during the COVID lockdown, but obviously the economies have bounced back. Carbon emissions are back up. We're currently on a trajectory. If you look at what the scientific community is saying, for a 3-degree warming world by the end of the century, I think that is. That's way higher than obviously the 1.5 degrees that was set at Paris and as the ideal. And people are saying, well, 1.5 to 2, that would be good. And I know you've got COP26 commitments, which, if you look at those, would indicate it would bring it down, the temperature down from 3, it would bring it down to a lower number. But if you like, I say this, it doesn't sound right, but say the distractions that we've got with inflation, the war in Ukraine, I think, if anything, should push the ES agenda harder, particularly around the energy piece, and because the world has been moving quite quickly towards renewable energy. And what the war in Ukraine has done is just expose the vulnerability, particularly of Europe, to that energy supply chain. And the great thing with renewables is, one, they're actually cheaper now. If you look at it on a level playing field, no subsidies, they're cheaper than coal, they're cheaper than oil, they're cheaper than gas to install from new. So we should be, and Germany, for example, has already said they're ramping up further what was already a fairly ambitious renewable program, because we need that independence of energy. And this is an opportunity also to install renewables in a major way. And the UK will be doing more. So I think, yeah, that whole energy environmental argument is very much intact. Short term, yes, coal, nuclear, gas, yes, it's just going to have to happen because of the war. But long term, I don't think it changes anything.
Yeah, it's the gas reliance that I think the war has really sort of brought to the forefront. But do you think that the push from governments on clean energy policies, etc., have caused some market issues, given that do you think there's been so much underinvestment from oil producers in oil refineries, in new production, because of the push against them in that area? That's also led us to see much greater oil prices that's also then stoking this inflation environment that we're in?
No, I don't. I think the problem is not that we have a shortage of oil in the world, and it's not that we can't get the oil out of the ground. So there's plenty. It's more obviously the disruption of the supply chain. And if you, as you say, you look at Europe and its dependence on Russian gas, it's very difficult to change that supply network overnight. You simply can't do it, because of the infrastructure needed. And no one, to be honest, was forecasting the Ukraine-Russia war.
Even if they were, they didn't expect it to last this long, I suppose, as well.
No, it's easy to forget, I think, but looking back at the beginning of the year, the build up of troops on the border with Ukraine, it was not new. It was something Russia had done before, and I know a lot of anecdotal evidence from Ukrainians were saying, yeah, there won't be a war. It's all right. Don't worry about it. Boy, were we wrong.
Yeah. Tragically, I don't think any of us actually thought it would transpire in the way it has, really.
No.
On a different note, given that we've seen inflation and we're seeing the central banks talking about, well, rates that they've already put up and about further rates, they're trying to sort of telemark our expectations a little bit going forwards. When we look at the tech boom of the last, particularly of the last 10, 15 years, have we seen the end of cheap money fueling growth stocks, particularly share price valuations in the tech industry?
I think, yes, we are seeing the beginning probably of the end of cheap money. I think it's relative, I mean, money has been cheap for the last decade or so. It wasn't, arguably, compared with the cost today, it wasn't cheap before that period. So yes, I think we are on a trajectory of the cost of money increasing, absolutely. And that will have a knock-on, obviously, it will have a knock-on effect to certain sectors. But again, I look at the reaction in some of the share prices of some of the tech companies, and it's not just about an increase in the interest rate or inflation. The valuations have got high. Some of those stocks, the big tech stocks, have got ramped up, shall we say, on the back of COVID. They were doing very well under the lockdown period, and now people are seeing a different world. And the market has got this habit of overreacting, both on the up and the downside. So my expectation is, whilst we've seen some, sharp sell-offs, when we gradually work our way through this, you will find those companies probably coming back up, not to clearly where they were pre this crisis point, but reaching a more sustainable level, a more sensible valuation level. Yeah. Again, it's easy to look at these things with hindsight, but we've had such a mix of factors. People say unprecedented, and in a way, I kind of feel it is. That low interest rate environment from a long time, QE, then the whole COVID lockdown, and now we're kind of tumbling out of that. There's a lot of factors at play.
Yeah, exactly. And even if people said they can predict the future and see it coming, stock clock is always right twice a day. But I think obviously markets rise the fastest and hardest before they fall. And you could have been sat on the sidelines for the last 10 years. You certainly wouldn't still be sat there being like delighted at the moment. You'd still probably be quite far behind where you would have been had you participated.
Yes.
And looking historically and a lot further back, we've seen a sort of risk reward playoff between traditional or Western developed markets and emerging markets. But actually, the US has been the driver over the last 10 or so years and provided the greatest return. But where do you see emerging markets? And maybe we could go a couple of regions by region.
Yeah, it's interesting. I think also you have to just bear in mind that when you look at America and you look at the returns, you know, the FANG stocks have been a key driver of that return. You know, it's the same as the way at the minute people are looking at the FTSE, you know, the UK FTSE 100 and going, hey, that's performing really well. Actually dissect it and you'll find it's a limited number of companies in a limited number of sectors. So I think, again, that goes back to kind of, you know, some of the things we talked about before, but you have to, I think, just look at these things in a little bit more detail to appreciate what's been driving returns. I think emerging markets, you know, again, I take a longer term view, you know, that as far as I can see, the growth drivers, particularly, you know, the population growth, the growing middle class, etc., is still very much intact. So I'm expecting Asian markets to emerging markets to continue to perform long term quite strongly. I think they have got better growth dynamics than Europe, than the UK. And the US, to be honest, because as I said, I think a lot of what we've seen from the US has been driven very much by that tech space. And I think, you know, maybe the day of the big tech company, the mega tech company, is just passing now. You know, maybe ESG is going to be the next big one. But I think long term, the emerging markets Asia are still in a good, strong place. Yes.
Okay, good. And I've largely focused on equities. We've talked a bit about fixed income. You know, can investors still find reason to invest in fixed income in a rising rate environment, basically?
Yeah, that's a tough one, isn't it? As I said, we just talked about the correlation of both fixed interest and equity on the way up, and now as we look at it on the way down. I think the answer is yes, because I think you mustn't lose sight about building a balanced portfolio. And that is something that fixed interest can do for you. It does and can provide a lower risk asset class. It can provide a yield. I mean, obviously you've got sovereigns, you got investment grade, sub-investment grade, you got EM debt, you've got a whole range of options there. So yes, I still think it remains an essential part from portfolio construction perspective. Yeah. It's always difficult in these current markets if you've got cash to kind of start from scratch and build a portfolio, but you know, you can look at it and say, well, actually, there are some, you know, really good opportunities opening up here. Prices are coming down. I can get into this market at some much more attractive valuation levels.
Yes, absolutely. And then, and sort of talking about building a portfolio and having a balance between equities and fixed income, how can alternative assets such as hedge funds, etc., so provide stability or uncorrelated returns in a portfolio, and do you take those into consideration?
Yeah, it's alternatives is I'd say a constant source of debate, because one, it's partly an alternative to what? Is it an alternative to equity? Is it an alternative to fixed? I sometimes think that's not quite the right way to look at it, because they are an asset class in their own right. But again, the challenge you have is it's not homogeneous. So when we talk about alternatives, we are looking at things from, hedge funds. Okay, these would be open-ended vehicles, a long-short hedge fund, which has probably got a net long position of 10 to 15%. So you're getting you've still got a directional trade there, but actually a far less magnified return profile than you would have from the market itself. And in these conditions, whilst it won't be going up necessarily, it's giving you a lot of protection from an overall portfolio point of view. So they're very much, for me, part of that portfolio construction process. But we also put in that same category things like physical gold, but that would go into the higher risk end. we put infrastructure and we use investment companies in the UK. So renewable infrastructure, so you're invested in the physical assets. One of the great attractions there is you've got a very secure income stream. So typically you're picking up something like 5%, and that is based on long-term contracts from semi or quasi-government backed institutions. So what we've seen with those, for example, is in this current environment, they perform strongly. You know, the equity market, the fixed interest market has fallen, and infrastructure, particularly renewables, has, if it's either remained flat depending on what they're holding, or it's gone up, which is really what you want to see from an alternative. But you're not always going to get that because again, it's the circumstances surrounding the markets which are going to dictate how they perform. But yeah, absolutely, it's very much on our radar, but quite a challenging sector sometimes. Yes.
Yeah. And okay, we're taking up quite a lot of your time, but as a final thought, so the S&P 500 has officially entered bear market territory, meaning it's fallen more than 20% from its all-time high. The question everyone wants to know is how low can it go, and when will we all know when the market's turned around? And then really, you know, joking aside, how should investors with money on the sidelines strategize this? I.e., how are Rowan Dartington preparing portfolios now for new money, looking at investing into the rest of 2022 and into 2023?
Yeah, I'll come back in 12 months and I'll tell you when the bottom was then.
Yeah.
So that's the only indication I think, you know, we are in a very difficult place at the minute, and there's still a lot of unknowns. And I think the Ukraine situation, whilst it's, I hate to use the term, seems to be settling into more of an, war of attrition, that doesn't mean that things can't change quite rapidly at some point, as everyone is aware. We run pretty much fully invested portfolios. So the way we've always dealt with these situations for new money, if the client wishes, is to phase that investment in. So if they've got $500,000, dollars, whatever it is to say, well, let's invest X. We could, today, let's do another chunk in. It could be a month's time, it could be 3 months' time. So we're able to work with clients on that basis. I think, no one knows the future. We're down 20% on the S&P 500. Maybe we're close to the bottom. I keep looking at a whole load of charts and different things to try and gauge where we are. And obviously, we simply don't know. So I think, and talking with colleagues and kind of their broad view of where we are in the next 6 months or so, is to maybe take it step at a time, take it cautiously. I do think putting money in now, because the valuations come down so far, for a new investor makes sense, absolutely. But I wouldn't put all of my money in at this point. And maybe this is the bottom. And maybe in 3 months' time, you're kicking yourself because you didn't put it all in. Maybe you're not kicking yourself because it's gone that much lower. And if it goes lower, although it's a tough one, because you've already put some money in and you've then lost money on that because the market's gone lower, to take that step back, think long term, think bear markets are part and parcel of what capital markets do, and drop a bit more money in then.
And that comes to behavioral finance again, doesn't it? The psychology of investing, where actually, if you're going to phase money in, realistically, you want the market to keep going down as you've got more to go in, even though that is counterintuitive to what your gut will be telling you.
Yes.
Whereas obviously, if you put it all in today, you want today to be the bottom. So the two slightly different ways of looking at it, I think. But certainly we can obviously help work with clients and strategize that. And it may well be again, psychologically, when when recessions are announced, if as and when, if they are in the US and the UK and Europe, etc., maybe because those are backwards looking, hopefully people can start to then look more favorably and promising towards the better times. But we shall see. We shall see. So yeah, pretty much that's we've taken more than enough of your time today, Tim. But we really appreciate you providing our listeners with your insight. And I look forward to discussing with you again soon. Hopefully, when the world has started to look a little bit clearer and a little bit brighter.
Yeah, no, let's hope next time we're in a much better place. Yes. No, thank you for asking.
Brilliant. Thank you, Tim.
Cheers. Thank you. Bye bye.